Hey there, Canadian Wealth Secret Seekers. We are here again today with another Friday Secret Sauce episode. And today I'm going to be unpacking a review of some permanent life insurance policies that are in place corporately owned by a business owner. Now, this idea for this episode came up on a call yesterday with a client, fantastic individual who's running into a very common incorporated business owner problem. And that is, how do we solve the retained earnings tax problem? As you know from previous episodes, when you are an incorporated business owner and you're earning active income, so this is not passive or investment income from, say, real estate or dividends or interest, but rather from the operations of your business, those dollars are taxed corporately as income tax at a very, very preferred rate, especially on the first $500,000. Here in Ontario, where we're from, that number is about 12.2% as of the date of recording. Every province is a little bit different, but it's all fairly similar. A few provinces are a little bit better on this front. But the problem is when we go to take that money out, the problem is now you're paying personal taxes. And as you know, when we talked on some of our previous episodes about taking a salary or a dividend, you know that if you take a dividend, well, the corporate tax stays, meaning you've paid corporate tax on those dollars, lower amount, and then you pay a lower personal tax rate, but it still equates to quite a good chunk of that money coming out. If I take a salary, well, I get the expense on the corporate side. I do have to pay CPP and EI and all that wonderful stuff on the corporate side and on the personal side, but then I'm now taxed at the full income tax bracket, depending on that amount. So if I'm only pulling out $50,000 or $75,000, I don't really have a big tax problem. But what ends up happening is, as those retained earnings over time, you might be taking out these little amounts to live your life and not necessarily taking all of it out because you don't want to pay more tax. And then you try to grow it inside the corporation. But down the road, those retained earnings will have to be taxed. So there is a tax target on the back of those dollars. Even if I take those dollars and then I grow them and I pay capital gains on the growth, or if I put them into real estate, I get a capital gain if I sell the real estate, but then I'm creating passive income, which is another tax problem. The issue is the cost basis, the amount of money I put into those investments, will still need to be taxed by some shareholder at some time in the future on the way out. So the big solution here is permanent insurance. Sure, term insurance can do it as well if you can time it right, but term insurance typically is for an untimely death, and that's why it's so cheap, and that's why everyone recommends it for the average individual, right? To take care of things if you need it. It's just like car insurance. It's just like property insurance. You don't want term insurance to actually be utilized. Permanent insurance will be utilized. It will happen. It's just, when will it happen? I always like to joke around with clients and say that mine is when I'm 110, right? When I'm 110, I'm going to have this permanent insurance payout. Now, of course, I don't really know when that date is, but I do know that it will pay out. And the real question becomes is, how do I design these permanent policies to maximize the use of these dollars? Because some would argue, Dave Ramsey and Susie Orman and all of these other financial advisors would argue that permanent insurance is horrible. And they're right if you're trying to solve the solution that term insurance takes care of. But they're not talking about business owners with retained earnings. They're talking to people who are in debt. They're talking to people who are just trying to get a budget going. So it's a different type of insurance. So permanent insurance is not for those people. But for business owners, it is a great move. And different forms of permanent insurance depend on the situation and the problem you're trying to solve. The problem I see out there is that most business owners are, of course, they like the idea of estate preservation. They like the idea of legacy, but that becomes more important as they get older. When they're younger, the real problem they have is, how do I maximize the use of these dollars? What should I be doing with them? And we like to do a little bit of both. Like, we want to make sure that these dollars are accessible, meaning we can leverage against these policies to have more asset growth, meaning I can leverage, like we do, John and I and Matt, we leverage our policies for real estate purchases, other people's leverage for other types of assets. Whatever you choose, it's up to you, but you have to make sure that there's some cash value in order to do so. I also like to know that I have an emergency fund available, be it for my business or if I have one on the personal side, which I do, I have that there for emergency purposes. I don't just have my emergency fund sitting in some sort of bank account there collecting dust. I'm doing I'm creating more benefit for myself, my financial situation by doing so. So today we're going to look at a business owner who has a retained earnings issue, and we're just going to show you the policies that are in place. And again, we're not saying these policies can't be good for anyone, right? Because the insurers are going to give the policy that the agent creates for the client. The insurer is entrusting agents like myself to be able to analyze your situation and be able to determine whether this is a good move or not. And then we apply for that insurance. So this particular agent looks to have solved the wrong problem, or at least at that time, maybe there was a lack of clarity as to what problem we were trying to solve, right? So let's take a look at these current policies. I'm going to go ahead and put this up on my screen. Anybody who's watching on YouTube, of course, this is always on YouTube as well. So if you want to be able to see and follow along instead of just listen, definitely make sure you check it out a little bit later. So this particular business owner has about $500,000 inside an incorporated business. Right now, it's an operating company. So that was active income. It's already been taxed, and there's about $500,000 sitting there. And each and every year, they anticipate like $100,000 to $150,000 of additional retained earnings. They don't need to take a bunch of money out every year. They have other income coming into their household. So that problem isn't an issue for them, is getting it out now. What they're trying to do is figure out, how do I grow this? What's the best way to supercharge this wealth inside the corporate structure without being taxed heavily? I could take it all out today as $500,000, and then guess what? I'm going to lose 40 to 54% depending on how you take it out and if you take it all out at once and so forth. So that's the problem we're trying to solve. And there's two policies currently in place. I'm not going to mention the name of the insurer because, again, this is not an insurer issue. It's not like the company's fault. It's the fact that you can design these policies however you want. So this particular policy was designed to actually protect, meaning they wanted to essentially create as much death benefit as possible in a permanent way. And they've actually attached a term rider on it to give a little bit of extra death benefit on it. That's never a bad thing to have an additional death benefit, but usually when we do it with permanent policies, we're trying to actually create additional paid up additions, meaning we want to be able to supercharge the growth of this policy and the early cash value. But in this case, you're going to see about $20,000 going into this policy. It's been funded for, let me see, it was about, what was it? I think it was like 9 years or so. 9 years. Let me double check that. So yes, 9 years. So about 183,000 has gone into this particular policy. And as you'll see, as we go and move along here, the cash value is only 45,000. So right now, this particular policy is designed to maximize death benefit, which down the road is helpful, or it's helpful right now if you know that, things aren't looking so good for me. But for a business owner, what you want to do is you actually want to start with a permanent policy that actually has less death benefit to start and more cash value, so that you're not taking that money and sort of locking it up. Because really what we've done is we've taken $183,000, we've locked it up in a vault. I can only access about 45,000 of those that money. That's like a quarter of the amount, not even a quarter of the amount. A fifth of the amount of that money can be accessed by this business owner. Now, is it all bad? Is it a ripoff? It's not a ripoff. If this is an investment, then sure, it's a ripoff. That's not really what this is for. This is for that death benefit, which started very high. I think it started at something like $1 million or something like that, and it's going to continue to grow. Right now, it's at about just over $1 million of death benefit, and they've been paying into this for 9 years. Now, the positive here is that some of these policies, this one is a 20 pay, meaning I can pay it for 20 years. and then it not goes away, the premium goes away, meaning it turns off the premium. We call that an offset. So it's sort of a forced offset at year 20. However, most insurers will allow you to request an early offset. When you do an early offset, what ends up happening is you get to keep the policy, but they restructure sort of the death benefit and the cash value and things like that. But you know that it's there, it's tucked away, but I don't have to put any more money into it. I'd rather see someone do that if that's possible than continue funding it in this format given their situation. Because again, we're trying to actually solve a retained earnings issue right now, not a death benefit issue. But I also don't want to see someone cancel the policy because the cash value is actually the cash surrender value, meaning if I cancel this, I'm going to walk away with $45,000. So again, if that's your plan, then of course this is a ripoff. We do not want to see that happen in this particular case, but we also don't want to keep contributing, $20,000 towards this policy if we can help it, right? So that would be something we'll look at with this particular client. Now that client also has another issue here because policy is owned by the company. I've got it all blacked out here so you can't see who this person is or who this company is. But my issue is that it insures a key person, which is the shareholder of the company. Amazing, perfect. But then if I look further on this page here, it shows the beneficiary as the spouse. Now, fundamentally, that's an issue because here's the thing. The spouse doesn't own the policy, and nor does the shareholder. The company owns the policy. So right now, this client, I'll be recommending and sharing this video with them, to be honest. This is how I'm going to communicate this information to them, is they're going to have to call this particular insurer, and they're going to have to say, hey, here's my policy information. I need you to update the beneficiary because it's a revocable beneficiary, meaning I can change that at any time. I am a key person in the company. I'm the president. I'm the this. I'm the whatever. I would like to change the beneficiary to the corporation because the corporation owns the policy, which means the death benefit's going to pay out to the company, but there will be a capital dividend account credit, which is where the tax-freeness comes from, meaning the spouse who will be left shares through the will. Or maybe the spouse is a shareholder, but at this time, I believe in this scenario, this is the spouse is not a shareholder of the company. The company must receive the money, and then the capital dividend account will create a tax credit of the death benefit, net of any premiums you've paid, and that's the adjusted cost basis because there is cost of insurance that gets taken off of that number. So depending how long we go, if we get to the average age of death here in Canada, your company is going to pay $0 in, I shouldn't say your company. Company will not pay any money on the death benefit. The next shareholder will pay no money in taxes on the way out. If I put this policy in place today and I pass on tomorrow as the key person in this company, there will be a death benefit minus the actual insurance premium credit going to the capital dividend account. Okay, so every scenario is slightly different. However, you can look at it this way and say that at least the death benefit minus the premium you put in is going to come out tax-free, but it's usually significantly more, assuming you have a typical lifespan. So that's something that's good to note. So we need that to change on this policy. And this policy, again, is a 20 pay. We're at year 9. So it might be this year. It's worth asking this year if we can offset this policy, meaning we want to keep it, but we want to stop paying. Can we pay it up early? That's sort of the language that we use there, because I would rather see that $20,000 go into a better design policy than this one here. And then they also have a second policy that was started in 2019. So this thing's been going on for about 4 or 5 years. And there is about $52,000 that's been contributed. It's $10,500 per year. Same issue with the owner. It's the company, and we need to change the spouse on that. So that's really important that the spouse is removed from this particular agreement. So we do not want the spouse to be getting that. We want the company to be the beneficiary because if that spouse gets it, then you're going to have a tax nightmare there. So somebody's going to have to pay tax somewhere. We don't want that. We want it to come out through the capital dividend account. Keep it clean, keep it easy. But one thing I do like about this policy, this is a policy that is designed for earlier cash value. Is it perfect? No, but it's fairly good. It's a fairly well-designed policy for this purpose. So this policy, I wouldn't necessarily say you need to offset by any means. Could we do it better? Probably. But this one we put in, looks like 52,000. The cash value is 34,000 after 4 years. I would say it's lagging a little bit behind where I'd like to see it going. But again, the cash value will start to grow significantly in the next couple of years. So when it's well designed, usually around year 4, 5, depending on age, maybe year 6, you'll see that cash value is actually higher than what you've put in. And onwards and upwards we go. Now, that's not always true. If we're doing a leverage now policy for a business owner with a significant amount of retained earnings each and every year, and they're going to use a leverage out immediate strategy, then the policy design is going to change. So I like to just note that in case we hop on a call and you say, you said this, why is it different for me? That would be a different scenario that we'd be looking at. So this would be more of a leverage, I'll call it leverage now for assets inside the corporation approach that we want to do when we want to rescue these retained earnings out. That's not a big enough retained earnings, and then the 150 a year per year isn't a big enough ongoing retained earnings to really justify an immediate leveraging out strategy that we can put in place in a compliant fashion. We would rather see you build a policy, leverage in the corporation to grow your assets, and then eventually that cash value is going to be substantial enough that we can apply some of our leverage strategies for income in a tax efficient manner. So if that sounds like you, definitely reach out to us. If any of this is intriguing, definitely let us know. I want to just tell you though, what I would do instead and what this might look like if we were to take this $30,000 and we were to start from square one with this particular individual who has this issue. So first of all, I would be looking at this saying you're retaining 100 to 150,000 per year. So 30,000 is nowhere near enough, right? Because if I do 30,000 a year, I've got another 70 to 120,000 of retained earnings that's going to pile up in there. I need those retained earnings to hit a policy the best way possible. So my issue there is I want to make sure that we continue to grow this thing, and we want to be able to build a policy that's going to allow you to put as much of the retained earnings in as possible. And it might look like this. So I'm going to start first off with what this might look like from a policy perspective, just at $30,000. What I would be doing, I'm showing one from a specific company only because their leverageability, they have the cheapest loan rates right now comparatively to some of the other companies. I also really like the company because they are pretty progressive and they give a lot of flexibility. So those business owners that have a range of retained earnings, I like to have a wider range of options for your premiums, the minimums and the maximums. So when I look at this here, you'll see on every illustration, you'll see a guaranteed side and you'll see a non-guaranteed side. On the guaranteed side, we're assuming that you're putting in the base premium, the minimum amount each year, which again, I always encourage people to, at least in the early years, use the maximum amount. We're going to design that policy to try to grow and supercharge the early cash value. So in the early years, that's what you're kind of aiming to do. It's not the end of the world if you can't. If, in year one, you're not able to do it, but in year two, you intend to, that can be fine, but that's the goal. But it also, guaranteed values, assumes that you're not getting a dividend, which again, dividend paying, participating whole life insurance policies, it's not contractually guaranteed, just like it's not contractually guaranteed to get a dividend from any dividend stock. It's just something that has happened and always has happened since they started paying a dividend. If they stop, that would be detrimental to the stock, or in this case, the product, the participating whole life policy. So we tend to focus on the right side of the table, which is the current dividend scale. In this case, they call it the non-guaranteed values because these are estimates based on the current dividend scale. All right. That's how it works. All right. So When we look here, we've taken the same $30,000 and we're assuming in this case that we're paying it for the full 20 years. You're going to notice that the cash value by about, let's see, 3 times, that's 150. Yeah, you'll notice at the 5-year mark with this policy, we have a total cash value above the 150 that's gone into it. The beauty is you also have a ever-growing death benefit happening right behind my big head there of about $700,000. That's by year 5. By year 10, you put in $300,000. Your cash value is about $362. Remember, this isn't an investment. This is to help you leverage against those retained earnings and create a tax-free windfall or slide to get out of the company. So we know that through the capital dividend account, we're going to get more than the retained earnings coming out to the next shareholder, be it my spouse, be it my children, be it a charity, be it whoever. That is what makes this such an important move. Now, as that cash value grows, $30,000 is not a lot per year to grow enough cash value to start justifying in the early years leveraging at a personal level. But if we want to leverage at a personal level, accountants who are listening, you have to reach out to us if you want to learn more about our structure and how we do this in a compliant way. We have to make sure that we're not getting a shareholder benefit and that we're crossing our T's, dotting our I's. So reach out to us if that's you. But you'll notice by like year 20 here, we have almost $1 million of cash value. By year 21, we have $1 million of cash value. I always use that as kind of my target before you start looking at a leverage out, quote unquote, now strategy. Especially if it's a small premium per year, you want to make sure that cash value is growing. The compound interest curve has taken off. So this is a much better designed policy for all $30,000 of that particular individual's retained earnings. However, it's not big enough. What I would recommend for that particular individual is I would be looking at $100,000 minimum amount for, well, this is going to sound confusing, $100,000 minimum maximum. Whoa. So the maximum amount I could fund should be at least $100,000. However, when we look at this $100,000 policy, which they can pay for the rest of time or they can offset it sooner, this particular policy, you'll notice that they can pay as little as $40,000 a year, which is a little higher than what they're doing right now already. They're already putting $30,000 in each and every year for a policy that doesn't have a great cash value growth. I can put as little as that in, but I can put as much as $100,000 in. Now, this is a very general policy. We haven't added any term riders. We haven't played with the buttons. We haven't, adjusted them. Just trying to show how very easily we can take a policy and we can give you a lot of flexibility. So here you have a much lower base premium. We could probably get that down by adding a term rider. So we will explore that with the client together and decide on how long are you funding it? How often can you fund the maximum in the early years? That's going to really matter for the term rider being added. And ultimately, you'll see the same idea happening by about year 5, because it's the same age person. By about year 5, we're going to see that the $500,000 that's been put in is now covered, and it's now the cash value is now above that amount. Right now, that $500,000 might be sitting under the corporate, mattress or under the couch or whatever, or in a GIC. GICs inside a corporation, you're going to get taxed at 50%. That's not fun for passive income tax. So this thing's going to grow like a GIC-ish, but in a tax-free manner. And the ultimate goal isn't that it's an investment, it's that we can leverage the cash value to buy the investments in the corporation until the policy has a large enough cash value that we can start leveraging out using compliant strategies through us and our team and our full disclosure packages. So if this is helpful for you, my friends, this is a secret sauce episode where we are taking it's 2 policies that are in force for a business owner, and we're trying to help them better understand how they can repurpose those dollars to get retained earnings to remove the tax target off of their back and help ensure that we're doing this in a efficient and compliant way, utilizing essentially the only real tool that allows us to accomplish so many things in the most tax efficient manner. So retained earnings, I can take them out and lose about half of it, or I can put a strategy in place and still be able to use those retained earnings to grow our wealth inside our corporate structure while not having to face the pain of the tax man when we eventually utilize that money and bring it out. If you have retained earnings of around $300,000, $400,000 or more $1,000 per year, we can actually use a leverage now strategy with you, completely compliant. So if you're interested, reach out to us at CanadianWealthSecrets.com/discovery and hop on a discovery call. And of course, if you've enjoyed this episode or any other episode, please do share it and rate and review the show. We are getting such great feedback, friends. It's so energizing. It's so awesome. And we are seeing more and more people downloading the episodes each and every week. And it's all because of you. Thanks a ton. And we will see you in the next episode. Take care.